But I was on Claude, the AI program,
Yep.
and I just asked it about market makers and how they manage their trades and how they manage their Vega and their Delta, and had Claude explain it all to me.
Yep.
It was super interesting. He even, like Claude being he, even like broke down what softwares they use and how they manage and what they watch and what they like when they want to be Delta long or Vega short or what, and then he broke down with the software and number usage versus experience of market makers.
Yep.
Super interesting.
Yeah, no,
It was super interesting, all from AI. Like, I understand the market maker position way more now from like 15 minutes of Claude.
and I think you're going to see that accelerate in a lot of markets. People are going to start to understand options in general, and you already seen that in the stock market. Like, option stuff is like, it was before, it was very, people thought it was very complicated. Now it's the super high volumes. They realize how much leverage you can get with a little bit of money is what happened.
Sure.
Like the regular people did.
Well, it's a good thing we're talking about options today.
Nothing like more derivatives on derivatives.
Oh, wait, you said your butterfly is not
wrong?
options.
What's that?
You said the butterfly you have is not an option butterfly.
There's butterfly and options. That's where you're going to see the term, and it's common. Like, that's what the first thing you're going to think of when you hear a butterfly, but it's actually in spreads too. It's just, first of all, spreads are not common to talk about, much less two spreads together.
Sure.
What we're going to do it today.
Welcome to Hedge Heads, where hosts Jon and Ryan Tungseth discuss commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. While no one knows where the market's going, they're not afraid to share some ideas.
Well, John, we had our own Christmas break and skipped recording last week. I'm sure we got a lot of angry emails, but I've been so busy I have not checked the email. I feel really bad. So if you emailed us, we'll get back to you next episode, I guess.
I guess people are more happy than sad.
Maybe. I mean, I haven't checked the emails. Maybe we got emails saying thanks for not recording.
We're building our fan base.
We are. But people don't want to hear about that. So let's get into some interesting stuff. How do you feel about corn this week? I feel like you've been a corn bull now for a month.
Well, it's an interesting number, and then my whole thing was common sense. Why would they put all the demand in December, all the demand up front, when they could spread it out over a number of reports, unless they were trying to get ahead of something? So that's using logic and common sense, which doesn't always translate into the USDA reports, which we have on Friday. And this is known for missing what the predictions are both ways. It's very common, especially corn. Been some wild surprises. So this is one where a strangle can work really good. This is a great report for that, where you're buying both sides in the option market, a put and a call, and you're just guessing that the average guesses are wrong, and it's gonna have a lot of volatility. This is a perfect report for that. Am I doing that? No, I'm not. It doesn't. The market's moving around very erratically. You see beans up 20, then down 20, and it doesn't have a lot of rhyme or reason, but it seems set up very well for that, because the option premium's really affordable. I mean, especially in the short term. But it would have to be corn that does it more than beans. But you really don't know this report. So I look forward to getting it out of the way. I plan on putting out a big sheet after this. I feel like we need this data to have what we need to plan on marketing for 2025. Without this data, I don't think that it's very easy to do. And judging by the calls, it's not. Everybody's wondering, not so much whether I should sell. I think that they are selling. I mean, it seems like if you look at the spread in March, May corn, it's widening out. They're bear spreading in corn over the last number of days. May, July is widening out. And, when you look at tight years in corn, we're not. The last 5 years, there's been 3 tight years, and it doesn't. It's on the lower end of all those tight years, way lower than when I think it was 1.4 or 1.5 a few years ago for the carryover. So we're at 1.7 something officially. We could go down to 1.6, and that you said bull market. It's what it is very close to being a much tighter market to where they're not going to be as comfortable. 1.7 is not that number, but we could change that easily on Friday.
That makes sense. I think just a note, because you mentioned the report Friday and that strangle would be an option for the report. But the other thing I think this report and most reports are known for is that first move is usually a fake, and then it starts going the other way right after the report. And so
that's why I don't want to buy
strangle,
Yep.
you have to be there right when the numbers come out, right when it's published, to actually make money on that strangle too.
Yep. And that's why I don't want to, because of the direction's been erratic, like I said, and it doesn't matter really what it's going to say unless it's a shock. But there's other years where it's, especially like in October and November when you don't know what the initial yields are going to be, that you could get a shocking number, and it works really good then. And a market like soybeans works the best. So I don't want to try to figure out, especially if it's corn that does it. It's like, you buy the strangle for, let's just say 20 cents, 10 cents for the call, 10 cents for the put. I don't know what it was. I didn't look before we went on. And it would probably be the March I'd be looking at, although you could do February.
I think there's 16 days left in February, so they're probably cheap.
In a lot of the major reports, you're going to find 16 to 14 days. It's super common that you have a short-term options that's really liquid. But I just don't. I would rather watch the report and then come up with trades after that, or hedges. I feel like you need that data. It makes sense. It's the final yield. And then there's other big numbers in there. So that's missing, and guys are kind of trading that way. They want to see the number. They've been selling corn, and you can tell that in the corn spreads. And I've talked about this a lot. I think that guys read and they try to find what corn's going to do. And I say repeatedly, and we're soon going to launch our subscription side of stuff, where you need to be following the spreads and basis, which are very close cousins, because that is the only true tell of what the commercials have or need. Of course, the funds do skew those spreads, and quite often in soybeans lately, where the front, like November, I think got -3 under January very quickly from -24. That would be November under the price of January. Quickly, about 2 weeks out before expiration, went to -3. And I know because I shorted that spread. It was one I actually got the high on. And of course, you have nobody involved when it works perfectly.
Right.
So it was a quick day trade. So I do remember that, and it collapsed back to where it started from. So lately, beans have kind of done whatever they wanted to do about 2 weeks out. And January did that as well. I did it. I don't know if it got above March, but I think it was even for a day, and then it collapsed. So you can't always read everything into the spreads. But corn's a lot harder to move. So you can wait a little more with corn. So seeing March widen out to May, meaning March is getting to be a little cheaper, or wide. It was at 1.65 cents recently, under the price of May, and now it's maybe 7 3/4. Still, it's still showing that the channels are filling up. Makes sense. That's what I'm hearing on the phones. Guys are moving corn this year, which ultimately sets it up able to rally later on. And that's not because everybody didn't know what they're doing. It's just that the channels, if demand stays good, are likely to clear out a lot quicker. And if you get some good news, then you could easily go up into springtime when we normally do. But and then I've had this pointed out to me numerous times, guys. When I'm talking about this, they say, "What about beans?" And of course, that's the big dark cloud.
I was just gonna ask, what about beans?
Yeah, and that's going to be the problem. So, how would I approach a market like this? It's in maybe a butterfly would work. And that's something I would consider spreading. So a butterfly is going to be, this is an advanced strategy. So we'll do one of these this podcast. That's going to be a butterfly spread, not butterfly and options. So basically, the body would be the middle, would be December 25. You'd be long, I would be long May. Short December 25, that's 1. Then I would be short December 25, long December 26. So the body is 2 short contracts and the wings are 2 long contracts. So I like these in the meat sometimes. It's got to set up right and it's got to be a seasonal deal. This year it's because of the outlook in beans and the idea that there's going to be a ton of corn acreage. And, so 25 is a good short. And then it'll go naturally to carry, which they've been taking out. 25, 26 has been taking carry out, and it's only -4 today, I think. What's normal for that spread? -20 going into spring. When it's tight, it'll be inverted because they need acres, and 25 will be over 26. In a year like this with 1.7 and an outlook for 96 million acres, you could easily see that at -20, which is very common into the springtime. Of course, there's no guarantees. These are just rough guidelines. So it's at least an idea that we're going to have to see the Friday numbers before I'd even consider doing something like this. And it's definitely not a recommendation because I just was looking at it today. But if it's going to get tightish in front in spring, May generally is the highest price contract. Everybody thinks it's July, but it's May. I mean, historically, that's where you see the highest price, the highest spread. I think May over July, not last year, but the previous years, 35 to 60 cents over July. That's the same crop year. One of those is the Russian-Ukrainian war broke out. But
some of that has to do with South America and with weather
it does.
all coming
Yep.
together at once.
Yeah,
is the reason it does that.
We own the export market till about that April time period, and then after that, sometimes depending on the weather in South America, like we'll have great July demand. Sometimes we don't. Sometimes, like last year, all the producers held it till July, and they just waited them out and made them puke it later on at a lower price. But this year's not set up like that. It's a lot of it's gotten sold along the way. There's still a lot in stores. Don't get me wrong, but it allows for us to get somewhat tight if demand stays good in the spring. So that's where, like, if beans are going to pull everything down, and I don't even know that that's true, but if they do, and it looks like they could, or at least not go up, then you might have to look to something like a butterfly if you're going to make money, or you could. I don't want to sell a strangle, that's for sure, because anything could pop up politics wise. If you don't expect the market to go anywhere, that's what you would normally do. Volatility is too low. I don't like it, and it's a time of year where that normally doesn't work. And then you have politics and all this new policy that we have no idea what it's going to be. From what I understand, we might have the Gulf of America.
Oh, the Gulf of America.
That doesn't affect the commodity markets, but it possibly could.
Well, I would say where that could affect the commodity markets is the reason there's talk of Gulf of America is I believe it's the negotiations between Mexico and America.
And the tiger shrimp on the Minneapolis exchange. That's where they used to be, actually. I don't think they still are, but...
So you can't trade tiger shrimp anymore?
You might be able to.
Okay.
At one point, you definitely could. I know that you can't with onions. That was made illegal a long time ago. But the Minneapolis has tried a lot of interesting products. I believe tiger shrimp was there for a while. I don't know if it still is. It's not even in Minneapolis. I think it's in Miami, the exchange now.
Interesting.
Yeah, that makes sense.
I worked downtown when the grain exchange was downtown Minneapolis. And
I don't know that I ever visited it when that was going full blast, but I definitely did Chicago a number of times. But that would have been interesting in Minneapolis. I wish I would have. I know where the building is. But the Chicago one was super interesting. Just like the movies. It was just like trading places. It was fun.
nice.
But, so we don't know what the policies are. So it's really hard to make big moves in these markets. But I also think over the next month that some really important decisions need to be made on marketing for old crop and probably new crop. And I'm seeing different approaches. I definitely have guys that have just locked in a November 25 price and then sold options on top of it and just said, hey, I'm going to get 1050 beans. I'm going to pay my margin calls. I mean, I wouldn't do that, but that's the numbers that work for them. And they know exactly what they're doing, and the bankers behind them. I don't see a problem with that if that works on their farm. For me, again, back to keeping the upside open. That's what I would be concentrating on, looking for strategies, and short dated options have been discussed. So for the clients, they like hopefully Monday, but maybe Tuesday, you'll get a sheet. It's going to have a lot of stuff on it: beans, corn, wheat, a bunch of different spread ideas, some option ideas. But we need to see this January report before I think that we know what we need to do.
Well, and as we talk about often, we don't know where the market's going. So the report is an indicator of where the market should go. And so it's hard to make hedging decisions without those numbers. If you want to speculate on the report, it's like pulling the lever on the slot machine, right?
This one's good. This one's good for that too. It is known for missing the mark by a long ways. The last report was not known for that, and it actually was a bullish surprise for corn. That's why we could see more surprises very easily. They're looking for slight cuts in the bean yield and the corn yield. But you start see why, again, back to why I like to keep the upside open at this time of year. You take a bushel off, and then you don't have perfect summer weather to get 96 million acres, which I have a hard time believing is going to get in at this price. But anyway, then all of a sudden, let's just say we're at 93.5 million acres, and we're at 1.6 or 1.5 eventually for carryover, then you have zero buffer for any weather problems. So everybody's giving up on this stuff, I think, far too early in December 25. But it's such a unique market where it's really hard to be bullish going into that March report. You know, the prospective plantings, not what actually gets planted, what they plan on planting, is probably not going to be a good corn number, or at least they're going to think that. So it's such a unique market where it has all this potential. Everybody's writing it off. You're seeing a different attitude. Everyone seems to be selling or wanting to sell early, lock a couple years in. And honestly, that's when you generally see market turns, when everybody kind of thinks it has to do one thing. But to say there isn't any risk on the downside's not true. I mean, there's a lot. And that's mainly all the conversations I've been having is you're just in a tough spot with where we're headed here, and no one has the answers. So it's not like you can go subscribe to somebody that tell you what to do here. It's just sometimes you have pure market risk, and that's exactly what it looks like you have here for at least the next month.
Well, I want to point out that that's why spreads are so important, and why we talk about them so much, especially with clients, is you just talk, do you think people are underestimating December 25? Or that, it may be too low, but you also recommend a butterfly where we're going to short 2 December 25s. Not a recommendation. You're watching a butterfly where you're going to short 2 December 25s. There's reasons for that, right? I mean, can you kind of explain how the spreads work in that?
Yeah. So
if all of a sudden corn takes off and you have that butterfly on.
Yeah, the idea would be that May would continue to gain on December, which it has since essentially harvest. Recently, I think it hit a high of plus 23, meaning May was 23 cents over December 25. Now at harvest, this looked like it was impossible for this to happen. Like 2.1 demand, who knows what that was going to be. And like, we're going to have mega carry in this market. Like you could, let's back up the truck and let's put a bunch of this on,
right?
Which I had plenty on, and it obviously didn't work. So they've been trending that way for quite some time. So what's realistic? May could easily get 50 cents over if the numbers go that way. You know what I mean? Lots of stuff could make it go the other way, but it's like that's a possibility this year. So that the May would gain on the December on that side. And then you could call it a hedge against a hedge. Normally December 25, 26, or 24, 25, 23, 24, the this year's crop, new crop versus next year, red and green, it usually downtrends into springtime. It's not uncommon, but what makes that one look like it's going to do that this year is the outlook. That one, I shorted December 25, 26, I would say 6 months ago at plus 13. I think I wrote it down to 0, got out, and then ultimately went to -8. And then now it's bounced -8, -9, and now it's bounced out of there, meaning December 25 was 8 or 9 cents under December 26, and now is -4 because they're unwinding some of the bull spreads. So if the report says that on Monday, that's something I would consider looking at. But I also don't want to deal with all the politics of every day. Like one stroke of the pen, or one policy decision could make the front of corn come down very, very fast with 250,000 longs. Just them liquidating would crush those bull spreads. So it doesn't come without a great deal of risk. But if they were hitting the May, December, I'm going to guess that they're hitting December 25, 26. So let's say you lose 7 cents up front. The back end's probably going to make up 3 or 4 cents. But again, you can only speculate on what that might do. They could go 2 different directions the wrong way. Cotton's a market that literally I've seen lock limit one direction and lock limit the other direction. Spreads can actually be more dangerous than outright positions. So this is almost a hedge on a hedge, but both sides are likely to work with what we know now. It's in a sea of ideas. It's okay. It's could just tread water and be 4 commissions for somebody too. You know what I mean? It's just an idea with the corn structure that we have. But I would not have this going into the weather markets. Like this is not something like you'd be out by the end of April.
And you're not going to buy it before the report on Friday either, because we need to know that info. Right?
No, I wouldn't consider doing it before the report at all. You're going to get some information. It's going to be useful. So you have to see the final yield before you could even make any of these. But it's just, if the market's not going to go anywhere, you got to look for stuff that actually could work. And this is an idea would be a butterfly. But there's not. Nobody's had great ideas. If you're making money, you're kind of sticking and moving, unless you're long cattle, which of course nobody is somehow.
Even though the price goes up every day.
Yeah, the one that goes up every day. No, it's just a way of, if it's too easy, you don't want to do it in commodities. You want to battle it out, be down a whole bunch, ultimately make $200 after 5 months, and possibly some crying along the way. That's the way you do it in commodities. You don't just watch it go up every day and have no sweat. That's no fun.
Right. No, I myself and a few clients, I love having that negative multiple thousands of dollars for a month or two, and then all of a sudden, I have $100, I'm getting out. And then it usually goes like plus $5,000.
Yeah.
Right. As soon as you take your $100.
Yeah. Or if you get a little option profit, you do the right thing and you take your profits, it looks like it's going to turn around and that thing will run like you've never seen an option run before.
But if you leave it on, it's going
right
the
back
other
to
way.
Zero, right back to where it came from and beyond.
Right. That's commodities. They look to inflict the most pain. Whatever they know.
As long as you accept that's your reality, 99% of the time you'll be fine in commodities.
Yeah.
But it's there, you need to see this information even before you can make decisions. Cattle market, which we just talked about, is just, it looks like it wants to take out that April high from last year. What was it? 199.87 and a half?
Yeah. It touched 2, but I don't think it closed on 2, right?
I don't think it touched 2.
Didn't it?
No, I think it fell
did.
just a tick or 2 shy of that.
We'll have to go back to our March podcast and see.
That was the top last year. So it looks like that's what they're going to try to do. You got 3 weeks left in the seasonal, which I just tweeted out, the seasonal chart, 5, 10, and 15 year. But January is often very strong in cattle for the cash markets and the products. We'll see. It's had a good run. That is a market that I'm actively recommending hedging strategies in. So call if you're looking at cattle stuff. But everything's running red hot there. Every day. It's not, feeders had a nice day, but it's not flying high. It's just a nice, solid kind of grinding up every day. But it's a very crowded trade, and it isn't different this time. And of course, it'll end eventually one way or the other. So, and probably end in tears. That's the way cattle goes. It's not like corn or soybeans or cocoa or coffee, where in a short supply, you eventually find a top like cocoa and coffee found. But like you'll find buyers on the way down, actual guys that use the product saying, hey, I need to fill some needs. You can't store cattle. So when people, the speculators, give up on cattle, it tends to be a very small exit door for everybody to get out. And you don't have these buyers that you have in these other markets that you can store. So cattle tends to be historically punishing, and then you tend to go too far the other way. Like, wasn't in September we were $18 under in the cash market, and it tends to overdo it to the downside, and that's likely to end that way. But from what level? I mean, who knows?
Right.
There really is no history on this other than, we're approaching the all-time feeder highs. Some of the contracts have already hit it, and live cattle is approaching some of the contracts are already all-time highs, but the April, which would be the highest price contract, is the one that hasn't taken out its high, the all-time high price. So, there's no history on it, and we'll just have to see what happens.
Right. I mean, I'm sensing that you see some opportunity, just not how to take advantage of it.
Yeah, I like cheap options. Feeder options are really expensive. So on the hedge side of stuff, you got your selling calls, buying puts, fencing it. It can be very margin intensive, certainly very margin intensive now. You have your flat out buying your put to protect. Let's just say feeders are 165. You buy a 160 put for 3 months at $5. So you have a 160 floor guaranteed or 260 floor guaranteed, and then see what it does. You have that, and you have guys shorting the contracts at various levels. So you see a little bit of everything in cattle. And a lot of people are going to the livestock risk protection. I'm not a fan of that, but that's super common nowadays because it's subsidized, and of course, nobody can lay off that high fastball.
Right.
So that seems,
and truly, why would you? I mean, with some of the...
it's going to be a great tool for some, and it's a terrible tool for a lot, and we won't get into it here, but it does definitely serve its purpose. It was a horrible product until they subsidized part of it. And then in certain situations, it makes a lot of sense. And then others, for me, I don't know why anybody would lose control of their hedge. Like, meaning I would rather be able to get out of my put anytime I want, because feeders have a tendency to overdo it. And I can think of times in the past, right offhand, one big one would be the mad cow disease. Like, you get this big scare, it sells off $30, and then you realize, pink slime or, whatever they got running cattle down, whatever it is, Oprah and the pink slime.
Right.
People are still going to eat beef, and then all of a sudden it comes ripping back. So I can't tell you how many times guys have gotten out somewhere along the way of their puts because they're in control. They can get out any day they want. Held on to the cattle, got down to a really low level. They didn't think they had any more risk, took it off, and then actually resold their cattle for, kind of where it fell from even. You can't do that with livestock risk production. You need that window. It pays in that window. But that's really, it fuels a fire. Guys feel like, hey, I'm protected. We can keep bidding them up here. So it's feeding on itself. But eventually, it won't be the supply that tops it out. It will be something in the industry, whether packers close down enough plants, start backing up cattle, the product, or shoving the product high to get their margins back, killing demand that way. It'll end in a different way, more than likely, than the herd growing a great deal, or the fund's shiny new toy they'll just get bored of, or it could be political policy that ends it. Something's going to end it. It always is. You'll hear, no, this one's different, or that's justify what I'm paying in the sale barn right now.
Right.
But it most likely won't end different than any other market that we've seen in the past. Although this one is bullish as I've seen it, so we don't have history, like I said, on it, and take it day by day. It's my advice.
Well, let's talk something that affects both grain and cattle, and that's interest rates.
Yeah.
We mentioned those a few episodes back, and I know there's been a few questions about the SOFR and those contracts. And
the SOFR, so you're basically it's secured overnight financing rate. It used to be Euro dollars, which would be American dollars on deposit in foreign banks. The short-term rates that are widely used by many companies and businesses around the world on a daily basis, banks to just smart business people. You can hedge your interest rates up or down, meaning if you think you locked in a too high a rate, you can hedge here. And I would get into more specifics of how you do that. There's tools available. That's a lot of it's just a market that people don't even know that that's available to them. Yeah, and there's different, obviously, time frames. So the SOFR futures are going to be short-term rates, but you can go out years in advance and lock in rates that maybe are attractive to you. And then also the 10-year is what they use for the mortgage rate. So there's all kinds of ways to hedge your interest rate risk up or down. And we won't talk a ton about it other than people don't even know it's available to them. And I was a little surprised at that. And is it often that I see a producer hedging their interest rates here? No, not really. But I just think it's lack of knowing about it, knowing how to do it. And it seems overwhelming and super complicated, and it actually isn't. Is it going to match your interest rate tick for tick? Absolutely not. No. We unfortunately don't have access to what all of the big players have access to at the window end. These are the rates that the banks are given, and they're going to take different degrees of profits beyond those rates. So you don't see the mortgage rate at 4.7 and get 4.7. I mean, you get 8. You know what I mean? It's just like they're going to make some money. So it doesn't match up perfect, just like a feeder contract wouldn't match up perfect with your cattle either. But it's a very good hedging tool. And I'd be more than happy to talk about how to use it. Now, I had a long conversation with one guy, one of my clients, before interest rates came up. He thought they're coming up. And I think he just didn't fully understand how to do it. And it's not super easy either, like, I'm guaranteed this rate on my operating loan. No, this is a hedge off that rate. So if you think you locked in your loan way too high and you think rates are coming down, you definitely can be a part of that. I don't know how your banker would feel about that. It's not going to affect your actual loan. You would have margin on a leveraged product here, but you can hedge your rates up or down. So
and actually the options are super liquid, so you wouldn't have to have margin.
Yeah, you can have limited risk on your hedges as well.
Yeah.
That's not common, in ag, but it certainly could be. But we're entering an environment where that actually you might have concerns, not necessarily today. Basically, they've cut rates and interest rates have gone up. Short-term rates have come down. So it's done the opposite of what they've intended in the back end. But there could come a day where that actually is a tool that you'd want to use. And it's very. It wouldn't hurt you to learn a lot about it. There's way too much to go over in like one episode, and we'll talk about it off and on.
Do you have a short example of where that could pay off, or you've seen or used? Or
before they started running up the short-term rates, I think a lot of people saw it kind of coming and they adjusted their rates. But beyond that, there was guys that were saying, "Hey, I'm afraid next year's operating loan is going to be 9%," and this is like a year or two ago, or it could be it's going to go up, and they wanted to know how to protect it. So you got basically $100,000 blocks. And you can see, let's say, for instance, you could go all the way out to June 27 right now. It's very liquid in the SOFR futures, for short-term rates. So you could lock in a short-term rate that you would get in that time period. But then you have your 2-year note, which is a government note, 5-year, 10-year, and 30-year. So you have longer term, So it's not going to guarantee you get that rate at the bank. That's not how it works. You're just hedging the risk to the upside. That is what you'd be protecting, a lower rate for a longer period of time.
So you're still going to get your operating note at 9% at the bank, but you made some money on this hedge.
Yeah, it's just like your hedging your corn here. You lose money. Yeah. You sold your corn here and it goes up. You're losing money here. You're gaining it on your physical corn. So an example would be you that's really attractive in that time period, and you want that rate. You can lock that in. So if rates go up, what you locked in gets to be worth a lot more. So they move inverse. So the bond prices go up, rates drop. Bond prices go down, which is what they've been doing. The rates go up. They move inverse. So that's why everybody gets confused on all this. Actually, once you dive into it, it's not confusing at all. Just it's a matter of learning about it. So nobody had talked about this for a decade because everything was near zero, off and on, up or down 1%, but that's what it was. There was no reason to talk about this. Then it started looking like rates could go up, and I know a lot of guys adjusted a lot of long-term debt, to lock in these lower rates. I know I did on the lake cabin and the house, and I'm sure you did. We happen to have a mortgage broker in the office, so that works out very well. For finding out new rates. So we were always, and he'll ask us about the 10-year notes because that's what they go off of in their industry. And, so we kind of go back and forth, and he's a good guy. But no one knew how to do it like I say, in different time frames. Like my operating loan renews every year, so I'm gonna have to deal with this a year down the road. Or my building I got a loan on is, I think, renews every 5 years. So
Depends
if I was
on your loan, but usually 5 or 7 with a 20-year.
if I was smart in thinking about it, I would have had locked that in a while ago myself using the futures. But I wasn't, and I didn't think about it, and was probably fishing. And now the next time it resets, I'm going to pay a higher interest rate. But it's not that cut and dry. It's something that you can learn about and use it as another tool. It's not something you just dive into and have it all figured out, because again, it's not going to match up perfectly, and you have to understand the risks that are can it differ wildly from what my interest rate is? It shouldn't, but you never know what kind of market you could get. The banks are going to be on the right side, and you don't have the rates you see on the CNBC, on the bottom scroll. You don't get those rates. I mean, the banks, like I say, tack on plenty. But anyway, it's a tool, and it's something that I like. I think it's really interesting. I've not been involved at all because it's very rare. What's happened is the Fed's cut short. They can only monkey around with the short-term rates, right? They can support the back end by buying bonds, which is quantitative easing, which they did in 2008. So that way they can control the back end of the yield curve, the 2, 5, 10, 30-year. That they can control it that way by basically printing money, which they claim they're not. But anyway, all those bonds they bought actually are probably worth a lot less than they were when they bought them. But anyway, so right now they lowered short-term rates, and where this gets confusing is what's happened is long-term rates went up, which you don't see. That's not a common thing to happen, but that's what's been happening. So I've been avoiding it because it's just historically very uncommon what's going on, and I don't know that it's really predictable. The market's saying, hey, we need more for the amount of debt in these time frames. Yes, you control the short-term rates, and that's fine, and they are. But the longer-term rates have been going up. So essentially, since they've made the cuts, the mortgage rates have gone up is what's happened.
And we hear about that in the office of people not understanding that, and it's hard to understand.
The concepts it can be hard to understand at the beginning, and now this is a market that's really hard to understand. So it's good to observe and watch what happens and learn from it. This can happen, and it is happening. It's where does it go from here? A lot of guys, if you doom scroll enough on Twitter, they're going to say it's the market, finally saying that's too much debt. We need way more money or way more interest to even consider taking out more loans on the government. So that's the argument they're making right now. Whether that's right or wrong, I don't know. And the gold bugs and silver bugs and everybody might be right. Fart coin's going crazy. I don't know what's happening.
Well, on that note, since you brought up Fartcoin once more,
I wish we didn't have to bring that up.
let's jump back to a minute to grains and kind of wrap up there, because we talked about it last episode. Should I sell or hold? Where are you at this week?
I think a lot of guys decided what they were going to do, and I think that there has been quite a bit of selling, and they needed to raise money. They needed to move it. You can't store it forever. And storage did work this year. You got better basis, and you got a better price. And it didn't look like that was necessarily going to happen. It didn't for beans, but I'm talking for corn. It definitely did. So at some point, you pat yourself on the back, said it worked. And that's what's been happening. Guys have been moving. I would say all of it. I would say way more in these time frames than we've seen the last 2 years. They don't want to get in that situation that they've been in. So I think it's just steadily coming in. Demand's fine. For beans, it's never been great, but it's okay. And now it looks to get a lot worse. Wheat is a very interesting market we didn't even talk about. And we'll talk about a lot next time. We'll save wheat for next time. But yeah, grain's been moving. They had a lot of, I think you saw it go up, and I think they just took that rally and sold some. And I think they did the previous rally when it went to 450 in March. Do you owe me a lunch, by the way? What was the time frame?
No, you owe me lunch. You owe
I
me.
thought it was a full dinner.
Oh, yes. You owe me a full dinner
No,
and
we'll
a
have to
beer.
go back to the tape on that.
It's actually on 2 episodes ago. You can listen to the outro, and it's on there. It was 460 corn.
I think it was a beer, actually.
It had to close over 460 before the end of the year, which it did not. It did make it up to 459 and a half, I think, on New Year's Eve, maybe. 458.
I'll tell you what. If I win, it'll be a dinner, and if you win, let's have a beer.
Well, for sure, I can tell you I win, or I did win, because I paid attention as the winner. But, I mean, if you want to make another bet, we can certainly chat on that. I got other...
Yeah, I just thought corn could have a little momentum after the report, but that's 1.7 number for you. It's not bad, but it's just not quite good enough to go by itself.
Well, and I do think that getting over that 450, it did inspire a lot of selling. So if there hadn't been that much to sell,
Yep.
or selling happening on that number, it would have kept going past that 460.
It seems like over the last 3 months, it's just been a nice stream of steady sales for everything. But that's what I'm hearing on the phones. Every time I call, I've moved some. They don't say I move half. They've moved some, and then every conversation you kind of hear that, and you just get an idea that that's what's happening everywhere, and the basis kind of reflects that. It'll kind of come up, you'll hear a good story, and then it'll disappear really quick because your neighbor took it. So that you've seen a lot of that. But guys, when the basis gets good, they've been taking it, and that's good. That's kind of what you're supposed to do with grains. Market on rallies. It's just not a price anybody likes, and that's the problem. But they also didn't like what happened the last 2 years, and there's a lot of fear that holding it will get you hold it to store it to lose 40 cents hasn't worked out either. $1 or $2 for beans. So it's
Right.
The selling at harvest has been right for the last few years. This year is the first year it hasn't been right for corn in a while, but it's been right for bean for 3 years.
At least the last 3, yeah.
Yeah, so corn finally broke that, but still, it's not an impressive deal. I mean, we would have been in a 30-cent range since forever.
Since September when it started trending up.
Yeah.
It's been in that 420 to 450 for
Very,
a
very
long
little
time.
opportunity. I'm sure there's somebody killing it. I want to hear about your hot strategy, but it's just not a range. Corn's already kind of not moving fast enough to make a lot of money anyway. So when it really barely moves and there's no option volatility, that's not a good combination. So guys, just have been watching the market and selling on the way up, and probably is going to continue through spring. And part of it's budgets getting tighter, need to raise money, and bankers have a lot more say. So back to the 96 million acres. That's why I think $7 corn in perfect weather you can get 97 million acres, but $4 cash corn and bankers breathing down your neck, I don't know that 96 is guaranteed at all. That's why, like I said, I think December 25 is a sneaky bullish, but way later. Super bullish or super bearish now and then bullish later.
So my question on that, and I'd love to hear from other people because I have no idea. I'm guessing, you can spitball an answer, but if it's not 96, what else are you putting out there?
I think it's going to be 93. What was it, 90 and a half?
No, but what are you planning on the other 3 million? You just not planning them?
Going to
would
barley.
you put soybeans in there?
No, and that's the problem with farming. It's like, those 3 million acres don't need to be in there, and they keep on, giving enough money to everybody to keep on doing it, just enough that 3 million acres needs to go somewhere. I don't know. They'll make something up. Like it looked like there was going to be 94 million acres of corn last year, or 90, and it ended up being 90 and a half because of weather. So that'll have a say too. It'll get in, and it gets in fast, but still 97 or 96 is a hard number to hit. With perfect weather and $7, I think that's an easy number to hit, but with $4 and, like I said, maybe some guys are locking in 10, 17 beans, hedge to arrives, and planting. But you talk to the seed sales, the insurance, and everybody, the hype is thick. 96 is the number you hear over and over and over again. I'm just saying, ultimately, when everybody's so positive of one thing, markets generally don't do that, especially that far out. Something comes along that changes it. But that's why I'm in my butterfly. If it doesn't, I got my butterfly.
No, I get it, and I mean I hear what you're saying on that 3 million, but if I'm leasing land, I'm planting something. I mean, what you have to. I mean, and I agree. We have Mike in the office here who helps farmers with their numbers on the financial side, and like you need those numbers to make financial sense. You can't net loss and do anything. You can't cut costs on a net loss, right?
Yeah.
But people are going to plant. I mean, you have to.
Well, there's probably some hard meetings with bankers happening right now. Nobody wanted to deal with it during the holidays, but now they're back to work, and they're going to have to deal with it. So these are actually conversations that are happening right now. I don't have a good feel for it at all. So it's not like the core acreage clearly looks like it's going to go to corn, 92, 93, but it's that other 3 that they say is there for sure. And I argue that, you look often, it doesn't live up to the hype. And $7 is very different than $4. Just because it's the tallest short guy in the room, it's expensive to plant, and it might fall with bad weather. That might change some minds. And then you also nowadays they plant soybeans sooner, and it just that'll have a say in it. Whether like it's perfect, it looks a lot cheaper to plant soybeans. But those 3 million acres make a huge difference. You have 93. And we roll into spring with 1.6, and political policy not affecting prices as much as they thought negatively, maybe even positive. Then all of a sudden you have a different market. So you're on that cusp of it could be really bullish, but I don't want to fall into the trap. That's what everybody hopes for, that higher price. Right. They're finally willing sellers, so I don't want to talk you out of it. Don't get me wrong. You have a lot of risk to the downside, and it's super unpredictable. But I'm just saying it's the market that everyone's given up, and they're positive it's going to do something. Usually it doesn't. And beans are definitely in that camp too. Like go back 6 years ago, it was $9. It had zero chance to rally. And it went from $9 to $12 because it kept raining all the way through March into April and ruined what looked to be a perfect crop.
Yeah. Well,
so you just
ruined some farms too, to be honest.
Yeah, exactly.
I mean, that's the bad side of those price moves like that too.
Yeah, the guys tend to want higher prices when you should be hedging in, which is June. Go look at the seasonals and tell me that that's not but that's when everybody wants to hang on, and they get scared into marking this lower price with all this scary talk. My point is, you have tons of unpredictable stuff, probably more than I've seen in a very long time, in a market that's getting more bullish. So I don't want to take out the upside, but I don't know how to manage all the risk. You have your short dated stuff where you could give up 20 more cents to the bottom line. So an example, what you could do is look at a short dated July, which 440s were 19.5 cents. So you're not going to give up 19.5 overnight, no matter what it does.
Yeah.
So let's just say you ride that for 2 months, see all of what's going on in politics, maybe even to the March report, see what's going to happen there, because this expires the 3rd week in June, and you give up, say, 10 cents, but you get to see a lot of information.
The reality is, with a July, with where volatility is, this is not a promise, but most likely in the next 2 months, as low as volatility is right now, you're probably not even going to lose 10 cents in the next 2 months.
Yeah, so that's it's like, why not give up a little more of the bottom line? It's already bad enough. Give up a little more and give it a chance, but don't do that on 100% of anything. But it's just like, guys just throw up their hands and think they have zero options, but market or don't market. Like leave the upside wide open and no protection, or market this price, and that I think that's a big mistake in a year like this, what it's got potential. I don't have good advice for beans, and I'll be the first to say it. It looks like a bad situation. But beans have a way of changing really fast too.
Anytime I feel like there's not a chance for beans,
it rallies every time.
I start looking for calls.
Yeah.
I just that's just because that's the way beans are. Same thing. If it feels like beans are going to $17,
especially if you actually short them,
I'm starting to look for the other side. Beans are crazy.
Yeah,
they have more lives than a cat.
If it looks like a guarantee it's going down and you get heavily short, it's you get ready for the pain train. But if you watch it and it looks like it's going to go down, it probably will go down every day. Yeah, like it's been doing.
Right. Well, it hasn't though.
No.
I mean, it took the one big step down to the 990 range or whatever. It's been 960 up to 10, but beans have been holding pretty steady, even though it's bigger swings because they're beans.
Seems like
It hasn't been crazy.
You could be in really good sync with the market and making money, by getting out, and you could easily be just every zig and zag getting you. It's one of those meat grinders, and it's very unpredictable.
Yeah. I think it's impossible to trade it. There's probably some way to hedge. I just haven't dug into beans to hedge.
And I also think we're gonna break out of the ranges we've been in one way or the other, and I don't know which way in beans and corn and probably wheat. I think that the quiet's probably close to done, and that's mostly going to be because of policy. Like what if they ban used cooking oil on day one, and like that'll breathe new life into soybeans really quick. Everybody assumes it's going to be all negative. It actually could be very positive for all anybody knows. We could own Greenland next week. I don't know.
Right. Probably not next week because he's got like 2 more weeks.
You're underestimating him.
Okay.
He's really working. He's really working on that today.
All right. Sounds good. I did see a hilarious political cartoon with him staring at a map of Greenland, and it had the buy button from a website on there. Or buy now or whatever.
Probably been the most confusing country I've ever seen in geography, because I remember staring at it in class, the big pull down, the little, the roll up ones, and it just looks like this gigantic thing, and it's explained to you it's really not that big. It's just the way the map's laid out flat. And I would nod like I understood exactly what they're talking. I still, to this day, it looks like a giant country that I'm told is not that big.
Yeah, I have no idea. So
flat map is it just doesn't scale very well.
Well, isn't it a flat Earth?
Yeah, yeah. No,
next episode.
Yeah, exactly. So we'll see. Yeah, I don't know. We need to see these numbers, and then I think guys need to plan.
Excellent. Well, if they want some advice on planning, how could they reach you?
218-731-1578.
Thanks, John.
Yep. Bye. Do you want to talk about politics and Trump and what may or may not happen?
No.
Me neither.